Hey everyone, welcome back to the deep dive. Before we get started, don't forget to hit that like button, subscribe to the channel, and tap that notification bell.
Uh-huh.
So you don't miss out on any of our future deep dives. Now, whether you're a student like cramming for exams, or an aspiring UPSC candidate, or even just someone who wants to, understand how the financial world works a little bit better, today's topic is for you. We're going deep into exchange rate systems.
It's a topic that's really important for the Indian economy and impacts us all in more ways than we realize.
Okay, so let's unpack this. What exactly is an exchange rate? I feel like I've heard this term thrown around, but I'm never really sure what it means.
So in the simplest terms, an exchange rate is just the price of one currency. It's expressed in terms of another.
Okay.
So think about it like how many Indian rupees would you need to buy one US dollar?
Right.
That's the exchange rate between the rupee and the dollar.
Okay.
And you'll see it represented as, $1 equals 70 rupees.
So it's like a price tag for different currencies.
Exactly.
But what determines this price? Why does the value of the rupee fluctuate against the dollar or other currencies for that matter?
Just like the price of anything else, exchange rates are mainly determined by supply and demand. And this all happens in the global foreign exchange market. So if there's a lot of demand for US dollars, for example, Indian companies importing a lot of goods from the US, the dollar's value is going to go up and the rupee is going to depreciate.
Okay.
Compared to that, yeah.
So if India's importing a bunch of iPhones, we need more dollars, which drives up their price, and our rupee kind of weakens.
Exactly.
That makes sense. But what about the opposite? When does the rupee get stronger?
Well, the reverse is true too. So if India is exporting a lot of goods and services like software or pharmaceuticals and foreign buyers need rupees to pay for those, then demand for the rupee rises and then it appreciates against other currencies.
So a healthy export sector is good news for the rupee. Excellent. You mentioned earlier, I think, something called the nominal exchange rate. Is that different from the regular exchange rate?
Yeah, good catch. The nominal exchange rate is the rate we typically see quoted.
Yeah.
It's a very straightforward conversion between two currencies without really taking into account any other factors like inflation in each country.
Uh-huh.
Yeah.
Okay, so it's just a snapshot of the current conversion rate without the deeper economic context.
Exactly. The nominal exchange rate doesn't tell the whole story. It doesn't really tell us how much a currency is really worth in terms of what you can buy with it.
Right.
And we'll delve into more sophisticated measures later, like purchasing power parity.
Okay.
Which gives us a better sense of the currency's true purchasing power.
Gotcha. Okay, I'm definitely intrigued. But before we get too far ahead of ourselves, let's talk about how these exchange rates are actually managed. In the real world, our sources mention different types of exchange rate systems. Can you explain those?
Sure. So broadly speaking, there are three main systems. You have floating, you have fixed, and then you have managed float.
Okay.
And each system has its own set of rules and implications for how currency behaves in the global market.
All right, so let's break those down.
Okay.
First up, floating exchange rate systems. What's the story there?
So in a floating or flexible system, the exchange rate is determined entirely by market forces, supply and demand, no government or central bank intervention. You can kind of think about it as a free market for currencies.
So it's kind of like a roller coaster ride.
Yeah, absolutely.
The value can go up or down based on, purely what's happening in the market.
Exactly. And the Indian rupee, after the economic liberalization reforms of 1993, moved to a more market-driven system,
Okay.
allowing it to float more freely based on supply and demand.
Okay, that makes sense.
Yeah.
But what are the pros and cons of letting a currency float like that? Is it good? Is it bad for the Indian economy?
Well, one of the big advantages is that it allows the currency's value to really reflect the true economic fundamentals of the country.
Okay.
So if the economy is strong, the currency tends to appreciate.
Makes sense.
And conversely, a struggling economy can lead to depreciation. And this can really encourage foreign investment because investors have more confidence in a market where the currency's value is determined by open market forces.
That sounds pretty efficient.
It is.
But you said there are downsides too, right?
Yeah. So the biggest challenge with floating exchange rates is volatility. Since the value is entirely driven by the market, it can fluctuate a lot, sometimes dramatically even, in response to global events, speculation, even just rumors.
So while it might be efficient, it could also be a bit of a wild ride for the rupee.
Absolutely. So let's move on to the other end of the spectrum. Fixed or pegged exchange rate systems.
Okay, so if floating rates are all about letting the market decide, what's the deal with fixed rates?
So in a fixed system, the government or the central bank decides on a specific exchange rate for their currency,
No.
and then they work to maintain that rate. Um, Often they do this by pegging the currency to something stable like gold or another major currency like the US dollar.
So it's like they're trying to hold the currency steady at a certain level, regardless of what market forces are doing.
Yeah, exactly. It takes a lot of intervention by the central bank to maintain that fixed exchange rate. Historically, we've seen examples of this with the Chinese yuan. It was pegged to the US dollar for a long time.
Yeah.
Yeah.
So what's the logic behind fixing a currency's value like that? What are the potential benefits?
The biggest benefit is stability. So fixed exchange rates reduce uncertainty for businesses,
Mm-hmm.
especially those involved in international trade. And it can help control inflation, which can make the country more attractive to foreign investors because there's less risk associated with currency fluctuations.
That makes sense. Predictability is good for business.
Absolutely.
But I imagine there must be some drawbacks to this system as well.
Of course, nothing's perfect, right?
Right.
So the main challenge with fixed rates is they can be very difficult and expensive to maintain. The central bank needs to constantly intervene in the market, buying or selling its currency just to keep it at that desired level.
So it's like a constant balancing act.
It is. It's a constant balancing act for the central bank.
What happens if they can't keep up?
Well, if a country runs out of foreign exchange reserves to back up their currency, they may be forced to devalue it.
Okay.
And that can have a really big ripple effect on the entire economy.
Intense. Okay, so we've got the free-flowing floating system and the very controlled fixed system. What about that third option you mentioned, the managed float?
The managed float, sometimes called the dirty float. It's kind of a hybrid of the two. It combines elements of both floating and fixed. In this system, the currency is generally allowed to float based on market forces. But the central bank will intervene strategically when there's excessive volatility or when they want to kind of nudge the exchange rate in a certain direction.
So it's like having a safety net. They let the market do its thing, but they step in if things get too crazy.
Exactly. And this is actually the system that India uses currently.
Okay.
The RBI, our central bank, generally allows the rupee to float, but it steps in to smooth out extreme fluctuations, to maintain a certain level of stability.
So it's like they're walking a tightrope,
They are.
trying to balance, the needs of the market with the stability of the rupee. This seems like a very sensible approach. You get some of the flexibility of a floating system, but with the RBI there to provide a bit of guidance and control. But to understand how we got to this system, maybe we should take a quick look back and see how exchange rate systems have evolved over time.
Yeah, I think that's a great idea. It's a fascinating history, and it'll definitely help us understand the context for where we are today.
Okay, history lesson time.
Yeah.
Take us back to the beginning. Where do we start?
All right, our first stop takes us all the way back to the late 19th and early 20th centuries, the era of the gold standard. During this period, major economies like the US and the UK, they tied their currencies directly to gold,
Wow.
creating a system of fixed exchange rates based on their gold reserves.
So the value of their paper money was literally backed by gold.
It was.
That's that's a pretty solid system, I guess.
Yeah, it was in terms of stability.
Yeah.
The gold standard definitely facilitated international trade and kept currencies relatively stable.
Uh-huh.
But it also had its limitations.
Oh, okay.
As economies grew and the demand for money increased, the fixed supply of gold became a constraint.
It's like trying to pay for everything with only a limited number of gold coins. Eventually, you run out.
Exactly. And that's actually one of the reasons why the gold standard eventually collapsed during World War I.
Okay.
Nations needed to print more money to finance the war effort, but their gold reserves just couldn't keep up.
It seems like every system has its breaking point. What happened after the gold standard fell apart?
So after World War II, a new system emerged called the Bretton Woods system.
Okay.
This agreement was signed in 1944. It aimed to, create a more stable international monetary system.
So what was the thinking behind Bretton Woods? How did they try to improve upon the gold standard?
So under Bretton Woods, the U.S. dollar took center stage. It was pegged to gold at a fixed rate,
Okay.
while other countries pegged their currencies to the U.S. dollar. This created a system of fixed exchange rates with the dollar as the anchor.
So it was like a gold-backed dollar was the king of the currency world.
Yeah, that's a good way to put it. This system worked well for a while, fostering international trade and economic growth after the war. But eventually it faced its own challenges, mainly due to the growing U.S. trade deficit
Yeah.
and the increasing amount of dollars circulating outside the U.S.
So too many dollars, not enough gold. Sounds familiar.
Right. And this led to this inherent instability in the system because a single national currency, the U.S. dollar, was also the primary global reserve currency.
Okay.
And, as the U.S. economy faced inflationary pressures, it became harder and harder to maintain the dollar's fixed value against gold.
So what happened? Did Bretton Woods collapse just like the gold standard?
It did. In 1971, President Nixon made the decision to abandon the gold convertibility of the dollar.
Wow.
And this effectively ended the Bretton Woods system. It ushered in the era of floating and managed float systems that we see today.
Wow. That's a pretty massive shift in the global financial landscape.
It was indeed. And this shift from fixed to more flexible exchange rate systems has had a huge impact on how currencies interact, how international trade works, and how we really think about global finance as a whole.
This has been a really interesting history lesson. So we've gone from gold to dollars to, well, what feels like a bit of a free-for-all with floating currencies.
In a way, yes.
Okay.
But central banks still play a crucial role in managing these floating currencies. They use various tools and interventions to, try to maintain order and stability in the global currency market.
Okay, that's good to know.
Yeah.
So speaking of central banks and stability, let's bring our focus back to India.
Okay.
You mentioned earlier that the Indian rupee went through its own evolution in terms of exchange rate systems.
It did.
Can you walk us through that?
Absolutely. So India's exchange rate journey really reflects these broader global trends, but, it also has its own twists and turns based on our history and economic policies.
Great. Let's rewind the clock. What was the situation with the Indian rupee before 1993?
So in the years after independence, India kind of followed that global trend of fixed exchange rates. This was influenced initially by British colonial policies and then later by the International Monetary Fund.
Okay.
The rupee was first pegged to the British pound and later to the U.S. dollar.
So we were basically playing by the rules of the global financial system at the time.
Exactly.
What changed in 1993?
Well, 1993 was a pivotal year for the Indian economy.
Yeah.
The government launched a wave of economic liberalization reforms, including a shift to a managed float system for the rupee.
So we finally kind of cut the cord, so to speak,
We did.
with the fixed exchange rate and allowed the rupee to find its own level in the market.
Exactly. And this move was really seen as crucial for making the Indian economy more competitive and also more integrated into the global marketplace.
That makes sense. So what's the situation with the rupee today? Are we still using a managed float system?
Yes, we are. The RBI continues to play a very active role in managing the rupee's exchange rate. They intervene in the market to curb excessive volatility and maintain, some stability.
So it's a delicate balancing act for the RBI.
It is.
They need to allow the rupee to respond to market forces, but also keep an eye on things to prevent it from going completely haywire.
Exactly.
What are the specific factors that influence the rupee's value in this managed float system?
So there are several factors at play. One of the most important is inflation.
Okay.
So high inflation in India can actually weaken the rupee. So as demand for foreign goods and therefore foreign currency increases.
Okay, so if prices in India are rising faster than in other countries, people might start looking for cheaper imported goods,
Right.
which drives up demand for foreign currency and weakens the rupee.
Exactly.
Okay.
It's like inflation makes our products less competitive,
Right.
which then impacts the rupee. Another crucial factor is interest rates.
Okay.
Higher interest rates in India can actually attract foreign investment, which strengthens the rupee as investors are seeking higher returns.
Okay, it sounds like a tug of war between different economic forces,
Absolutely.
each one kind of pulling the rupee in different directions.
It's a great analogy. And the RBI is in the middle, trying to manage these forces and keep the rupee relatively stable.
So the RBI is like the conductor of an orchestra,
Yes.
trying to keep all the instruments in harmony. This has been a fascinating overview.
It's complicated stuff.
It is. I'm already starting to get a better grasp of how exchange rates work, but we've only just scratched the surface here.
We have. There's lots more to come.
What else is what else is in store for our listeners as we continue this deep dive?
So much more. Welcome back to the deep dive, everyone. Before we kind of jump back into all the, the details of exchange rate systems, I want to touch on something that's closely tied to the Indian rupee's freedom or maybe lack thereof in the global market. We're talking about currency convertibility.
Currency convertibility.
Yeah.
Sounds like something out of like a spy thriller. You know, exchanging briefcases full of cash in a dark alley.
Yeah, maybe not not that dramatic, but it does involve some restrictions on how easily you can convert Indian rupees into other currencies like dollars or euros and vice versa.
Okay, so it's about how easy it is to swap rupees for other currencies.
Yeah.
Why do we even have these restrictions in the first place?
There are a couple of key reasons. One is about managing volatility. Imagine if everyone could freely convert their rupees into dollars whenever they wanted. Even a small economic hiccup could trigger a massive exodus of capital, and that would lead to a sharp depreciation of the rupee.
So it's like a safety valve. These restrictions are there to prevent a sudden rush for the exits.
Exactly.
That could destabilize the whole system.
You got it. These controls on convertibility are designed to prevent rapid capital flight
Okay.
and protect the rupee from extreme volatility.
Okay, that makes sense. But what about people who need to convert currency for legitimate reasons, like
Yeah.
traveling abroad or paying for imported goods?
Right. So that's where the difference between capital account convertibility and concurrent convertibility comes in. So current account convertibility refers to the ease with which you can convert currency for transactions related to trade, so importing and exporting goods and services, as well as remittances and income transfers. In India, we have pretty open current account convertibility.
Okay.
So you can easily, convert your rupees to pay for your trip to Europe or that, shipment of Italian olive oil.
Okay, so traveling and trading goods are covered. What about capital account convertibility?
So capital account convertibility deals with transactions related to investments, things like foreign direct investment, foreign portfolio investment, and borrowing money from abroad. And this is where India has tighter controls in place.
So if a foreign company wants to invest in India or an Indian company wants to borrow money from overseas, they can't just convert unlimited amounts of currency.
That's right. The RBI, our central bank, sets limits on these types of transactions to prevent those sudden, large-scale inflows or outflows of money, which could really destabilize the rupee and the economy.
It seems like a tough balancing act for the RBI. They want to encourage foreign investment, but they also need to protect the rupee from these wild swings.
They do.
So where do we stand on this issue today? Are we moving towards full convertibility, where there are no restrictions on converting rupees?
Full convertibility is a very hotly debated topic in India.
Okay.
Proponents argue that it would attract even more foreign investment, boost economic growth, and really integrate India more deeply into the global financial system.
Sounds good.
It does, but it's not without risks.
What are the potential downsides of full convertibility?
Opponents point to the increased risk of volatility and the possibility of sudden capital flight. We saw this during the East Asian financial crisis in the late 1990s.
Yeah.
They argue that it could expose India to currency manipulation and make the economy much more vulnerable to global shocks.
It sounds like a high stakes decision with potential benefits and risks. So what's the current approach?
So India isn't going for full convertibility just yet, but the RBI has been gradually liberalizing the rules for certain types of capital account transactions. They've eased restrictions on companies borrowing money from abroad, and they've allowed people to send more money overseas through the liberalized remittance scheme.
So it's a step-by-step approach towards more openness with the RBI carefully weighing the pros and cons.
Exactly. And the pace of these reforms will likely depend on a variety of factors,
Okay.
including the strength of the Indian economy, global economic conditions, and the RBI's assessment of the potential risks involved.
It's a complex issue with no easy answers.
Yeah.
You mentioned earlier that global events